Hi folks, the possibility of a recession keeps stressing Canadians out, as it clearly gets harder for many to save as much as they did before with increasing prices of gas, food, dining out and many other everyday items. The stock market has been tricky as well, as even the safest and most stable companies were going down pretty hard. Not to mention tech stocks being completely demolished in the last 6 months, leading to an average of 31% portfolio loss for retail investors, meaning folks like us. Yes, the situation seems to be slightly improving, but right now I'll be still cautious about excessive optimism. As we've all seen in the last couple of months, the market goes up by 2% in 1 week, then loses 4% in the very next week, and so on and so forth. In times like that, Canadian dividend stocks and ETFs simply are personal finance savers, especially considering that the best products are now heavily discounted, which makes it a perfect buy opportunity for both beginners and experienced investors. If you want to take an advantage of a current market downturn and invest in the safest tools available for Canadians to grow money while also receiving great dividends, then you've come to the right place. As you probably know, dividend stocks and ETFs have quite a few advantages compared to individual stocks. They're less risky, you get a regular payback in dividends while the price of your assets keeps on growing. It's always nice to have an appreciating asset that also pays you back in dividends. I mean, it's better than having a car that sucks out $1,000 per month out of you on gas, insurance, maintenance, while also depreciating in price. Just compare like having a ETF or dividend stock, solid dividend stock holdings, compared to having a personal vehicle. When looking for dividend stocks, it's important to select companies with future growth potential, and not only because the company pays great dividends or has the highest dividend yield. That is a huge mistake. It is certainly a better strategy for most people than keeping your money in a high-interest savings account. And it also beats Canadian GICs, which is another great way of growing your money during the recession in case if you're not feeling completely comfortable investing in the stock market during this crazy period, and that's understandable. For those people, I released a separate video on my channel a few weeks ago and reviewed the best HISA and high-interest GICs for Canadians, explaining how they work and what's available for you right now. So you're more than welcome to check that out right here. Okay, let's chat about the best dividend stocks and ETFs to fight back the recession and help future you financially, all in one video. Don't forget to subscribe to that channel and like this video, that would be tremendously appreciated. And let's begin. The first ETF is a Vanguard product VCE that is heavily invested in Canadian banks and natural resource companies, which help deliver standout short and long-term results while offering a 2.5% dividend yield with super low management fees. With interest rates rising, banks naturally tend to make more money as it becomes more expensive for businesses and individuals to borrow. These times are huge for banks as it leads to increased profits, which should later reflect on VCE performance. On the other side, with Russia's war and invasion of Ukraine, there is no telling how much higher the natural resource companies will go in terms of prices, following the oil increases. That explains why, despite the market sell-off, this ETF is still in the green, showing 5% growth on an annual basis. 0.06% MER and 0.05% of management fees are a pretty great deal too. In case your portfolio is already heavily reliant on banks and natural resource companies, you might want to pass on this ETF, but for everyone else, it is probably one of the best products available right now. Let's take a look at the Canadian oil and gas companies for a second, like Pembina, Enbridge, Suncor Energy, Vermilion, CNQ or Cenovus Energy. Despite the majority of the stocks being crashed in the last 6 months, the natural resource companies are showing outstanding results and growing anywhere from 50 to 85% from the beginning of the year. Just look at Suncor or Cenovus to see how impressive their returns are, and you will know what I'm talking about. Not to mention most of them are paying great dividends, much higher than any tech or retail company, in a range of 4 to 6% usually, so essentially triple from your savings account. Who would have thought that the Canadian oil and natural resource companies would lead the growth for 2022, while so trendy and promising big tech, pandemic darlings and growth stocks would be completely demolished and be losing from 40 to 80% of their stock prices in just a year. And yet, another case of why diversification within different sectors is key. Before we get back to the best Canadian ETFs, I would like to touch up on one more great dividend play. As you might already know, the CIBC recently had a stock split and now trades at $67 per share. With my case about increasing interest rates, which leads to an increased bank's revenue, I would suggest the price could likely move over $70 by the end of the year. Plus, it's not even a growth stock, but a safe dividend play with a solid 4.71% of dividend yield, which almost matches with the oil and gas companies I just mentioned, only it's a safer play with more opportunities to grow. After all, it's one of the biggest Canadian banks, and it's not going anywhere. Anyways, that leads me to the next selection of the day, which is one of the best dividend stocks with great growth potential. After those, we will get back to ETFs. Okay, how many people just thought of Enbridge? Sorry folks, but not today. Even though Enbridge remains one of the best dividend plays in Canada with an astonishing 6% dividend yield, I've already talked about that in detail in my previous dividend stocks video, so let's concentrate on alternatives today. After all, Enbridge isn't the only leader when it comes to Canada's finest oil and gas corporations. Let's start with Pembina Pipeline. Pembina has an amazing dividend yield of 4.84% or about 60 cents on a share quarterly. A bit lower than Enbridge, sure, but it's never a good idea to keep all your cash in just one company, in one basket. It is still one of the highest dividends out there that beats any JC or a saving account by more than double, and Pembina still has the potential to reach $60 per share and higher. Okay, full disclosure, I have my personal investments meant for dividend income spread between Pembina, Enbridge and Suncor Energy. Now, Suncor is having smallest dividends payout compared to others, but in my opinion has a higher growth element and potential long term, simply because Suncor has the highest net profit margin and the most impressive financial results compared to the peers in the last quarter. Now, let's continue with the biggest ETFs for those who want to invest in US companies and bet on the economic recovery overall. These tools will give an opportunity to own the entire US stock market while providing with the highest growth opportunity, low management fees, and slight dividends. Canadian ZSP and XUU are the great choices for those who want to be invested in the US economy, especially considering that both are down by a solid 15% since the beginning of the year. I would consider that a pretty juicy discount for those who wish to enter into a diversified ETFs product scene. Both ETFs are replicating the performance of S&P 500 and are designed for those looking for growth solutions, which will definitely pay off once the market gets back on its feet. Eventually. By investing in one of these, you get exposure to diversified US equities, while also benefiting from the currency appreciation. Both options have dividends and super diversified holdings across many sectors, low management fees, and attractive entry price. ZSP has a medium risk rating and a rather unimpressive 1.4% dividend yield, while iShares XUU has 1.3% dividend yield. Definitely not much. But keep in mind that these aren't exactly dividend plays, but a growth ETFs, so having even that kind of yield is nice. Still beats most savings accounts in Canada. Management fees are super low as well, 0.08% with a 0.09% management expense ratio for ZSP and 0.07% for XUU. Not the lowest out there, but still pretty low. The main difference between the two is that ZSP is mostly based on tech, having the main holdings like Apple, Microsoft, Google, Nvidia, and many others, while XUU has more financial companies and healthcare sector covered. You know, it's pretty clear why these two ETFs have been having a bad time recently, with the tech stocks being completely demolished and all that, but besides mentioned companies, there's about 500 more stocks under the umbrella of these ETFs, covering different sectors from healthcare, finance, industrial and energy service, and more. Pretty diversified. Well, I hope you enjoyed this video. Leave your like if you liked it. Don't forget to subscribe to my channel and leave a comment about your opinion, what you think was helpful, what you like, maybe have some suggestions. I always reply to all the comments and I would appreciate seeing yours in the comment section. Thank you so much for watching and I hope I will see you next week. Bye. Strategy, tragedy. Unique New York, unique New York. That's the video from a woman I found about the good English pronunciation, so I'm trying to learn from that. Unique New York, unique New York. Tragedy, strategy. Tragedy, strategy. Tragedy, strategy. Okay, I got it.